On July 31st, 2025, a letter from U.S. Customs and Border Protection, CBP, triggered one of the biggest shocks in the gold industry's history. It was short and sweet. Gold bars weighing 1 kilogram and 100 ounces now hit with a 39% tariff. The result? COMEX. Futures prices shot up, hitting a record $3,534 per ounce within just hours. Switzerland, the world's biggest gold refiner, was stunned. Shipments were immediately frozen. The U.S.-Europe gold trade completely shut down. But this wasn't just about gold. This was a message from President Donald Trump. No product is safe from U.S. tariffs. Switzerland, the world's gold refining capital, was the biggest victim. With the ability to process over 2,000 tons of gold each year, the country controls most of the world's refined gold supply. In the 12 months leading up to June 2025, Switzerland exported $61.5 billion worth of gold to the U.S., with around $24 billion of it in the 1 kilogram and 100 ounces bars, now slapped with tariffs. These numbers don't just show the market size. They explain why this move felt like a sharp blow to the industry's core. Up until now, traders believed gold, especially standard gold bars, was untouchable in tariff wars. It was considered a safe commodity because of its stable value and its vital role in global finance. But in the blink of an eye, all those assumptions crumbled. The safety of gold turned out to be just an illusion. The immediate impact was severe. U.S.-Europe gold transactions froze completely. Shipping contracts were canceled or indefinitely delayed, leaving tons of gold stuck in customs warehouses. The price gap between U.S. and European markets widened, allowing speculators to cash in, but throwing the global supply chain into disarray. This imbalance threatened to break the unified pricing system that the modern gold market relies on. Many Swiss refiners had to freeze exports to the U.S. until clearer legal guidelines were provided, risking both legal and financial troubles. This hit international liquidity hard, especially for central banks and investment funds needing physical gold. The deeper issue? Confidence in COMEX, the U.S.'s largest gold exchange, began to waver. When something as fundamental as gold bars is suddenly hit with tariffs, investors worry that COMEX futures will no longer reflect the true value of the physical market. Some experts warned that if this continues, COMEX's role as a pricing beacon could shift to London or Asian trading hubs like Shanghai and Singapore. Canada may not be one of the top gold exporters to the U.S., but Ottawa knew this wasn't just a Swiss issue. It was a message and a threat aimed at any U.S. trade partner. If gold, something once considered off-limits in trade wars due to its stability and reserve role, can be dragged into the fray, no industry is safe. And that reality came faster than anyone expected. Just one day after the gold tariff was announced, Canada became the next target. The White House slapped a 35% tariff on all goods from Canada, not covered by the USMCA, a blacklist including key pillars of Canada's economy: steel, aluminum, softwood lumber, and car parts. The numbers don't lie. In Q2 2025, Canada's total exports dropped 13% year-over-year, according to Statistics Canada. But the biggest blow came from energy, which makes up nearly 1/5 of Canada's GDP, falling nearly 20%. The hardest hit area? Alberta, Canada's oil and gas capital. Multiple extraction companies had to cut production shifts and reduce hours to manage costs. Several refineries and manufacturing plants temporarily shut down, pushing thousands of workers into partial unemployment. This not only slashed household incomes, but also had a domino effect on service industries like transportation, maintenance, and logistics. The 35% tariff didn't stop at the border. With Canadian steel and aluminum, once a cheaper source for U.S. manufacturers, now more expensive, costs in industrial states like Michigan and Ohio spiked. Trade analysts warned that this attack on Canada would eventually come back to bite U.S. industries reliant on cross-border supply chains. Trump claimed tariffs would bring jobs back to America. But 4 months after expanding tariffs to over 70 countries, the numbers tell a different story. 30,000, 40,000 manufacturing jobs in the U.S. were lost. These aren't just numbers on a report. They represent tens of thousands of families in Michigan, Ohio, and Pennsylvania losing their main source of income. Each manufacturing job in the U.S. has a double ripple effect on the economy, meaning hundreds of thousands of other people are indirectly affected. Major industrial companies began to cry out under the weight of tariffs. General Motors lost $1.1 billion, the entire company's net profit in one quarter. Ford lost $800 million in just a few months, forcing them to halt several production upgrades. Apple had to set aside $1.1 billion this quarter just to pay taxes, enough to build a large iPhone assembly plant in the U.S. These costs don't just vanish. They're passed straight on to consumers, driving up product prices. And it didn't stop with cars and phones. Prices for consumer goods spiked across the board, from shampoo and shoes to your morning coffee. The U.S. imports about 1/3 of its coffee from Brazil, and now this product is also facing tariffs. A typical bag of Arabica coffee, which used to cost $8 to $9, now carries an additional 15–20% price tag. American consumers began feeling the invisible weight every time they swiped their card, though not everyone knew the cause was the very tariffs praised as protecting America. Prime Minister Mark Carney took a calculated approach, not retaliating with tariffs, but shifting trade strategies. Instead of dragging the supply chain into a cycle of retaliation, he kept negotiations open with Washington while expanding ties with Mexico and the EU. In the first week of August, Finance Minister Chrystia Freeland and Foreign Minister Melanie Joly were in Mexico City, working out a $15 billion trade agreement that included a 20% increase in steel and aluminum export quotas to Mexico compared to 2024 levels. Both Canada and Mexico are looking to July 1st, 2026, when the USMCA review clause could be reopened. The goal is to form a bargaining bloc with a combined GDP of over $4.3 trillion, or nearly 18% of the total GDP of Latin America and North America. What's interesting is that Mexico got a 90-day extension before new tariffs hit, while Canada received no such privilege. This difference pushed Ottawa to seek out more anchors beyond Washington and the EU market, with a two-way trade value of Canadian dollars 93 billion, became a top priority. If successful, Canada could reduce its dependence on the U.S. market from 72% of its export value to about 65% by 2027, a historic shift in the country's trade structure. At first glance, this strategy seems like a well-calculated game of chess with three clear moves. The first was a surprise attack, targeting gold, a commodity once considered off-limits in trade wars due to its stability and reserve role, to break Canada's defense. This wasn't just an unusual move, but a direct hit at Ottawa's $24 billion export market, which accounts for over 70% of the gold bars sent to the U.S. each year. Next, the strategy expanded, targeting high-value industries like cars, EV batteries, and aluminum. Canada's car exports to the U.S. reached over $42 billion in 2024, making up 15% of total bilateral trade. Striking here meant attacking the heart of manufacturing in Ontario and Quebec, while forcing U.S. automakers into a parts bottleneck. The final step was to take advantage of short-term opportunities, launching continuous strikes before Ottawa, Brussels, or Tokyo could form counter-alliances. But this is where the strategy turns into a gamble. Each counterstrike will hit the U.S. back, raising domestic gold prices by 4% in just 2 weeks, increasing electric vehicle import costs by 8–12%, and pushing thousands of jobs in industrial states like Michigan and Ohio into instability. Trump may be playing to win quickly, but the data shows that the long-term costs, from losing export market share to the risk of Canada strengthening ties with the EU, could turn this tactic into a self-inflicted wound for the U.S. economy. And as the retaliation waves continue, the question isn't who wins, it's whether the U.S. economy can survive the very storms it has sparked.